traders and investors. My name is Roger Scott, and with me is 𝗧𝗴𝗀 from Joy of the Trade. Now, folks, this is our midweek roundtable. We host this every Wednesday. Please, 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 we want to hear from you. Reach out to Jeff@joyofthetrade.com. My email, real simple. We'll get to me real quick. support@marketgeeks.com. Again, that's Jeff@joyofthetrade.com. support@marketgeeks.com. Jeff, how are you doing today? How's your week so far?
Doing well. How are you?
I'm doing wonderful. I am doing great. I'm at the studios. You can see it, and you are in your office there. Beautiful. I love always seeing the background because it's so sunny and nice.
I'm a little dressed up. I just got back from my son's elementary school graduation. Normally,
congratulations!
That's the occasion, but
that's wonderful. How old is he?
He's 11. He's going into 6th grade. They stopped at 5th grade down here, so it's pretty nice.
Interesting.
It was weird. They had to do drive-through because of like still having COVID protocols in Dade County. So, but you know.
But yeah, I mean, it is what it is. And you know what? The odds are next year the topic COVID is probably going to be a distant memory.
For sure.
You know, so tell me, what are you seeing in the markets? I know we had big report last Friday. We got the jobless claims tomorrow. What's your view here?
Actually, the big number tomorrow that everybody's been waiting on, in my opinion, is CPI. That's going to be a massive event. We have, the big thing, the big conversation has always been inflation. Is there inflation? Is there no inflation? We know there's inflation, but the market needs to see it in its classic economic indicators. And the CPI there's nothing bigger than that to tell us if we have what we don't have. China, which came out with their producer price index last night, had their highest producer price reading since 2008 last night. And since China is a great manufacturing country, that PPI number is really important there. Inversely, as we are a consuming country, as we know really well, our CPI number, so it's kind of like it flows from there to here, is a number that people pay close attention to because we're on the consumer end. So the U.S. consumer price matters.
We're not exporting too many things to China these days.
Yeah, just a little economic nugget for those people out there. People pay close attention to Chinese producer prices because they're a manufacturing exporting nation. Right. In the U.S., we look for inflation in the consumer prices. That comes tomorrow. In front of that, we've seen interest rates take a real dive lower underneath 1.5% on the 10-year, which is a significant psychological number. So that's been a bolster for tech and whatnot. But I'm interested to see what happens tomorrow. Tomorrow's the real game. There's been like lackluster volume in equities in general, other than the meme stocks. We've seen year lows in volume in the SPYs and the S&P futures and all these different metrics. So be interesting to see how that shakes out tomorrow.
It really is, and I'm in agreement with you. You kind of have a little bit of have a couple of different things going on. You have the indices near all-time highs.
Right.
You've got sectors that have been really hot, like industrial basic materials, kind of cooling off, but not really melting down, just kind of cooling off a little bit, moving sideways. Mm-hmm. You've got tech rising with interest and the Russell rising again. They're at 2-month highs right now. The XLK sector, the Russell 2000, as well as the 10-year bond. But at the same time, you've got the put to call ratio at 0.65 this morning. Yeah. And you've got my momentum levels that I'm not even going to talk about now because we talk about them so often, probably sick of hearing about them already. But so you kind of have on one hand, you have on a market breadth level, you have a classic overbought market, but it's being driven so much artificially right now by the stimulus and the low rates that it's really interesting to see what's going on. Too much of a good thing is actually bad, so it's a real good time for swing traders and for people who want to get into market timing because you have so many different factors moving things. It's not like a year ago where we're recovering from COVID. It's the same song and dance. You've got so many different factors on the table now.
We've got a lot of different factors, and we've got this. So we're in this moment in time where what's really happening, what's really amazing is all of these, not micro caps, but like small mid cap stocks in the Russell. That's where all the action is, all these meme stocks. And it's not just the meme stocks, but like all kinds of stocks in the Russell that are mid cap. that are value plays, that are weird, startups. There's like 20%, 30% moves are not uncommon in stocks in a given day underneath the hood. A lot of the action is in IWM stocks, if you look underneath the hood, and like highly shorted stocks. We've been talking a lot about that. But it was in the beginning of that short squeeze phenomenon, limited to like GameStop and AMC. But that's not the case anymore. Now it's like the top 25 or top 30. I'm scanning this almost every day to see what's on that list of the highest short interest stocks in the Russell 2000. So that not massive large caps, but like these mid cap type of stocks, you find great swing trade opportunities in those types of situations. I think you're finding nice setups in that. But broadly speaking, I haven't seen if you look at just the S&P 500, if your spaceship landed from Mars and you just looked at the daily range bars for the S&P 500 from about mid-April till now, we've been in under a 3% range from high to low in the S&P 500, which is like, it's almost unheard of. It's kind of just like going sideways, trudging along for, weeks and weeks, which is wild to me. But
and let me just make a comment about something that you said that's actually really important. You mentioned the IWM, the Russell 2000. I follow that index quite a bit, and I did some back-tested studies on it a few years back. And I continue looking at these studies. I keep following them throughout the periods, and consistently, if you look at the top, say 3, 5, 10 stocks in the Russell 2000, and you compare them with the top gainers in the S&P 500, again over a 6-month period, every 6 months or every couple of quarters, you will find that the average stock, and I've been doing this for years now, that the average Russell top stock outperforms the top S&P stock by a factor of 6.5 to 1.
For
the
sure.
Delta.
Yeah.
Talk about Delta, right? Now, again, when you start now, don't get too excited because
there's risk. Yeah. Those are risks.
You got absolutely. You got crazy volatility. It's a smaller stock.
Yeah.
The float is much smaller. But as you get deeper down, you're going to have a lot more crappier stocks because they're smaller caps. So you got 2,000 stocks. Sure. Maybe you'll have the first 50 will be, but then the rest will be dogs. where the S&P, you're not going to have that that huge run with the first 5, but most of them are going to do okay. You're not going to have crap outs.
Well, what I'm seeing that's interesting is that so a year ago, I think retail traders accounted for 10% of total volume in single stocks, and now it's 20%. So overall in the entire U.S. stock market. So when I say retail trader has doubled their impact in the stock market, it's no question. And retail traders are looking for those experiences. They're looking for the bigger bang for the buck on single stock selection. Otherwise, you're just going to spray money into ETFs and mutual funds traditionally, which is what everybody's bank and brokerage advisors doing for them. But this phenomenon is really growing, and it's not something that I think we should discount or say it's transitory. I don't think it is. I think this is just how the new stock market game is being played, and you just have to adapt or die. I mean, you can sit there and be like an old curmudgeon and be like, "Oh, those stupid little kiddies, what are they doing with these crazy stocks?" Or you can say, "How do I find the next one these kids are going to go mental over and get there before them?"
or fade it.
Or fade it at the end. Or fade it at the end. Fading, it's good. I'm going to be quite frank with you. Please. I don't fade those types. I part of the reason I'm looking at that list is I'm taking those names off the list of stocks I would burn on a burn notice and put them on the fade because the risk reward is just so inverted. It's so skewed. Right. I'm not trying to get, a big 200 because remember, when you're short stock, and this is for the people at home, obviously not for you, you have infinite loss potential just being naked short. If you short something at 10 and it goes to 100, you lost 10 times your money. But if you're long you can only lose 100%. So the mathematics of being short are always skewed against you. So when I look for fades, specifically on the short side, I'm very, very cautious not to get into names that could double or triple overnight because they're just insane moves.
Sure. You're being what is called a responsible trader. You don't want to, it's all about risk and reward because you really, and folks at home, Jeff and I sound like we know what we're doing, and most of the time we do. But the truth is, this is a numbers game. It's a probabilities game.
Yeah.
Our job, we may find 10 stocks and we may be right on 7 out of 10 or 8 out of 10, but we won't know that till after the fact. So those 2 stocks, we don't want to be stuck, as Jeff said, and lose 10 times our money in those 2 stocks. That's not going to be good. So this is being very responsible and just using the numbers in our advantage as opposed to our disadvantage. Let me ask you a couple of more questions, Jeff.
Sure.
You mentioned inflation. You mentioned bond market. Is there any particular subsector that you're looking at to take advantage of that? Basic commodities? Are you looking at basic materials? How are you timing this inflationary pressure? Because there's a lot of talk about it, and I'm not seeing it going away anytime soon.
It's not going to go away anytime soon. But, this move in bonds is peculiar because if you have the type of inflationary pressure that you're seeing in commodities, that you're seeing in the stocks, that we feel as consumers, that you see on the streets, you would expect that rates continue the move that they did in the beginning of this year, in the first quarter of this year, and, test that 2% range on the 10-year, on the upper band of the rates. But we've had this peculiar move where it's getting softer. So it's kind of like the bond market is telling us that it doesn't believe that inflation is there, that the inflation is as strong. If the bond market is correct, and bond guys love to say, we know everything, and we're smarter than the stock guys, and we always predict the macro best. If the bonds are right, then you're going to see a big smackdown in basic materials and commodities and commodity stocks.
Which is why I asked you that question. Now, let me tell you what I think. I don't think that's going to happen.
Right.
You and I both know that the bond market over time is a very, very choppy market. The bond market ain't the Japanese yen. It's not a trending market. It's a very counter-trending market. And think about it logically. Do you see interest rates soaring back and forth over time? No, interest rates are a sign of stability. It's a counter-trending market. Remember, stocks are based on interest rates. Currencies drive interest rates drive stocks. It's just the way the game works.
For sure.
The bigger the market, the bigger the drive. And folks, currency market is about 10,000 times bigger than the stock market. Just FYI, the global currency market's very big. So no, here's what I think. I think you are 100% right. I don't think this is transitory. I think it's here to stay. And I think we are going to go higher on the bonds. But here's what I think. Here's my theory. I think we're going to move back down on the bonds, and I think interest rates are going to go higher, and I don't think we're going to have a major washout on basic materials and industrial stocks. So I am in complete agreement with you. But let me tell you why I think the bond market is rallying. I think the employment data that comes out, think about when the bond market broke out to the upside. It broke out on Friday with the employment data report. And and I think that the move we're seeing is a relief rally, because a lot of investors and traders were praying to God that 266,000 number that we saw was in fact a fluke.
Right.
So I think the market is relieved right now because of the number. Because I'm going to tell you, if last Friday's number was 300,000, 250,000, I don't think the bond market would be moving higher. I think it would be moving lower. So I think this is a relief rally, that the economy is in fact picking up based on that employment report. But I think this move is going to be very short term, and ultimately this is a move against the main trend and not a new long
counter trend move. Yeah. So I'm of two minds about it. I think that you can't really. My problem with reading into the bonds too much is that it's the most manipulated market in the world right now. That's where the Fed does all their stimulus. That's where the Fed is buying 60% of the market every freaking day. So if you want to find a distorted asset price, the most distorted asset prices are bonds, because the central banks of the world are buying bonds constantly. They're not buying stocks the same way.
Yeah, there's a lot of noise. There's a lot of noise in bonds right now.
Yeah. So I'm not putting too much credence on that, but the effect of rates still passes through to the stock market. That's what you were saying, and I agree with you on that. I'm nervous that you get a big CPI read tomorrow. The market was flat-footed on it. Bond yields rip back up, and you get a tech smash because tech has been kind of like, okay, the coast is clear. We're not going back to what I'm saying is maybe bonds go back to what they were doing, and we get a short-term blip in maybe like a quick washout in this tech rally we've been having. And
very possible. Very possible.
Yeah. I think that's probably how I'm leaning to play tomorrow. Is I'm leaning that we've been running on lower and lower and lower volume, lower and lower and lower enthusiasm, and we've been vacillating near the top end of this all-time high in this range. But whenever I see that there's no kind of emphatic boom through that, I kind of start to feel like, you know what? It's almost like a runner that's getting to the end of the race and is losing a lot of steam right before the finish line. The chance that they lose the race just like goes up exponentially.
The fundamentals, Jeff. Yeah. Remember when we started this conversation, I said it's very interesting because you have a complete case. You have momentum levels. You have put the call ratio saying one thing, and then you have technical saying complete. So your argument fits perfectly on the fundamental picture, by the way, on that side. It perfectly, and and also momentum. Technically, I'm seeing the opposite, but again, it could be just a fade out. So it'll be
the weirdest part about it is that I can't, because this IWM thing is like its own separate animal at this point because of all of the stocks that are in there. A lot, because they have the cool stocks in there. They have the GameStops, they have the AMCs in that index. Those are not in the S&P 500. If you look at it from that standpoint, you think to yourself, there's almost like two separate markets. There's like that market, and then there's the stock market I'm talking about that are traditional stocks, S&P, Nasdaq stocks.
Well, yeah, because there's hypersensitivity. Because there's hypersensitivity to your point. Because there's hypersensitivity to those stocks right now,
and they're much more liquidity driven, right? Like you can, because the fact that they have a float of a couple of million shares, some of these names, you can manipulate these stocks in the options market with a lot less money. And the money keeps coming through no matter what. That's the thing. Like this cash, because of the stimulus every day, this hose is getting sprayed with dollar bills, and it's coming into the market and it's got to go somewhere. I don't know if you saw this, but reverse repos, which is where banks go to the Fed and say, take our money, give us some overnight securities for almost free, but we have too much money. So banks have too much money. They're trying to give it back. It's at like at a multi-year high right now, which is strange because you would think that the Fed, that's an example of too much of a good thing starting to be a bad thing.
Right. Agreed.
Just another indicator. It's not something that really matters to stock traders so much, but it's something to pay attention to macro.
It's part of the big picture. It's very important because everything starts out with the big picture and goes down, narrows. And again, that could be a major trend change. It's something I would strongly suggest our readers pay attention to. Yeah. Let me switch topics a little bit. Let me focus on something else. You've been fairly bullish the last maybe 3-4 times we've had a chat, probably the last few months. You've been very bullish on, not very bullish, but you've been somewhat bullish on the energy market.
Oh yeah. I still am.
Tell me, what are you seeing? What do you think? And I think we have a petroleum report right now at about 10:30, actually, coincidentally coming out. Didn't time for that, but
I think the crude gas move is going to get stupid this summer on the upside. And I think the stocks could capitulate on the upside. Stocks are still lagging the commodity by a lot. Stock traders in oil are still thinking prove it, stay there. They're asking, is this a transitory move in crude? And I think they're going to get an answer soon of no. And it's higher prices are going to be here to stay for a pretty decent period of time. And it's not like I'm just like coming up with this theory, pulling it out of like my magic hat. OPEC controls the price basically through how much oil that they produce every day. And they've said, we don't care that the economy is opening back up in Europe. We don't care that the United States is on fire. We don't want to start producing more oil for a long period of time. So as long as those guys are sitting there in Russia and the Persian Gulf and saying, we are comfortable with higher prices for longer and we don't want to produce more, guess what? You're going to have expensive oil, specifically with this dollar collapse and everybody trying to buy anything priced in dollars in the world. I mean, that type of tailwind is not going away.
Agreed. I completely agree with you. And just to comment on that, from a personal experience, I've been looking at ATR levels on the energy markets, and I've been looking at it at technical levels, and I'm not seeing any fake out gaps that usually occur near market tops. I'm not really seeing any major increase in volatility, which usually signals a choppy period. Everything still appears to be moving in a very smooth, even direction. And that typically signifies that there's more momentum and there's more upside on the way.
True.
Let me ask you one more question, if I may, before we go. I want to get your opinion on cryptos because there's been a lot of volatility. Yeah. I don't want to leave any stones unturned. So what's your take?
This move and so you've had amazing fundamental news come out this week with nation states like El Salvador, mostly Central and South American countries, El Salvador, Panama. These places are coming out and they're adopting Bitcoin as a national currency, as an option for their citizens to use as currency. And that's massive. That's a game changer. That's a historic proclamation. In a lot of ways, Bitcoin kind of solves the problem a lot of these countries have in fostering a stable
economy,
fiduciary environment for their citizens. Think about it. And so if you live in a place like El Salvador and you're constantly earning a depreciating currency, it's almost impossible for you to get out of that spiral of going down. But if you're earning all of a sudden in Bitcoins in Panama City, that could be a game changer for the country, to the upside, for the better. And so I don't see how you can just ignore that. It makes me more bullish long-term on cryptos than I was. The caveat to that is that United States Treasury doesn't want competition.
You sure took this is a big, excuse my French, but this is a big FU to the U.S. government. But
if you think of it from their standpoint in other countries, what has the dollar regime done for them other than kept them in a state of constant poverty?
Right. Right. Hey, American, it's no secret. I mean,
I see a situation where you could have both, where you could still have the dollar be the best fiat currency and Bitcoin and Ethereum, and the crypto space still goes.
I think this is going to increase liquidity and decrease volatility, which is only going to increase interest in cryptos. So I think this is a very, very positive move. But again, I wanted to get your opinion.
I think it's bad for gold as a fundamental case. It's bad for gold. More than anybody.
It's not really great. It's not really that great for the US dollar right now. I mean, it's kind of
it's not great. It's not great for the US dollar. It's not great for the US dollar at all.
But it is what it is. And
but again, the dollar still trades. Like if you trade the dollar, if you're an FX trader, you're trading against the euro, you're trading it against British pound, you're trading it against the yen. You're not trading. You have it against asset prices. But I think it's also inflationary. It's definitely going to be inflationary.
Absolutely. Of course. Yeah. Of course. Yeah. There's no question about it. Jeff, this was a wonderful session. I'm really glad that you and I have a chance to kind of explore what we're thinking and how we're looking at the markets. And I think this gives traders tons of usable information, data, and something they could really gain an unfair advantage in the markets from. So I want to thank you very much for participating with me in this mental exercise for half an hour.
Thanks for asking me good questions. I appreciate it.
Absolutely.
I don't get asked good questions all the time.
I try. Let me ask you, can you tell us a little bit about how have your programs been doing? Any cool trades you want to talk about? Anything you want to tell us before we conclude?
I mean, everything's going great. I mean, we have, in the monthly money flows, which is one I don't really talk about a lot. It's a monthly trading strategy and it's kind of a momentum name. We have a couple of cool, IWM types of stocks in there, squeeze types of stocks like pets. So petsmed.com, and the ticker symbol is PETS. That's a stock that's going. And, I'm taking advantage in that of a more intermediate trend and finding different sectors that are breaking out. It's very much like, we're both momentum players, right? But this is like pure momentum play in terms of the time frame, because it goes on for a whole month. The month is still young, but if you want something to where you don't have to look at the market all the time. That's a good system for a lot of people. They should check it out. Monthly Money Flow Elite.
Especially during the summer months. You guys heard it.
Boom.
Monthly
Yes.
Money Flow Elite.
Especially during the summer months.
When you guys are not around the computer. Monthly Money Flow.
And neither are the bosses. Neither are the guys that move the markets around. That's why the market's doing nothing every day.
Exactly. Very good. Very good point. Jeff, thank you very, very much. And again, folks, if you want to reach out to Jeff, please do. He doesn't bite. He's available. He'll answer your questions.
I will.
Jeff@joyofthetrade.com. That's Jeff@joyofthetrade.com. Feel free to reach out to me. My name is Roger Scott. You can reach me at support@marketgeeks.com. I want to wish all of you a wonderful, wonderful week ahead. Jeff, I'll talk to you over the week, and have a great day, everyone. Thanks for joining me. Bye, guys. Bye.